All right, we are less than a minute to the closing bell. To help us break down today's action after we get the gavel, Michael Jones from Caravel Concepts, CEO, and also Sarah House, Wells Fargo's senior economist. But let's take a look at where we're setting up right now, because sector action, consumer discretionary has been big today, pulling back just a bit, but that sector up almost about 1%. In fact, the only sector that is in the red today, S&P 500 sector, is the healthcare, down about 1%. Also, keep an eye on the airline stocks today as we go into the close, because we have the international travel will resume on Monday, and we're watching Delta, United, American all go higher. So as we say that, let's go to the closing bell.
And there's the gavel. That wraps up another week on Wall Street. Again, a record-setting day here after that stronger-than-expected jobs report that we got out before the bell. Dow, S&P, and NASDAQ all closing the day to the upside. The Dow up over 200 points. S&P up just around 0.33%, and the NASDAQ up at 31 points. Michael Jones and Sarah House are here to break down the action that we're seeing. Michael, I'll kick it over to you first, because looking at the market's reaction today, another day of record highs, investors are clearly excited about the jobs number that we got. How are you viewing where we are in this recovery and what we could expect from the markets going forward?
Well, I almost hate to be a cautionary note after another record-breaking week and with the market completely unconcerned about the Fed tapering. But I do think it's important for investors to take on board the huge change that we're going to see in the investing environment over the next 6 months. For the last year and a half, we've been running higher based on better than expected earnings and massive liquidity injections by the Fed. Now, we think going forward, we keep the better than expected earnings, but we're going to lose those massive liquidity injections by the Fed starting this month with the tapering in purchases. And that's important because we're still going to have the problem that caused the Fed to have to print money in the first place. If you remember, they didn't print money because of COVID. They printed money because in September of 2019, we found out we couldn't finance $1 trillion deficit and a growing economy. And when the bond market stumbled, repo rates hit 10%, the Fed bailed out the Treasury. As they taper their purchases, we're still going to have $1 trillion to $1.5 trillion deficit. And that's going to drain liquidity out of certain sectors of the market to finance that deficit, and that's going to be a big change for certain sectors.
When you talk about that draining of liquidity, Michael, I think a lot of people are wondering how quickly that'll come. And Sarah, let me pose this to you, because we're looking at when the Fed stops purchasing, it's $10 billion. Combined, it's $15 billion. It's $5 billion mortgage-backed securities, $10 billion in treasuries, and yet they're still going to have more than $8 trillion on their balance sheet. So what Michael's worried about, Sarah, is that really cause for concern? There's still a huge amount of liquidity that's going to be in the system.
Well, I think I'll leave that to the market strategists. But when we look at what the Fed's thinking in terms of the overall labor market and the overall recovery, so I think they're going to be pretty happy with today's report. I think it shows that there's still a lot of momentum in the economy, and I think that justifies the taper that they announced earlier this week. And I think overall we're still seeing a tighter labor market than perhaps what they were expecting and what many folks appreciated, which does suggest that there's going to continue to be some pressure on discussion of when exactly they begin liftoff.
And Sarah, when discussing, I guess, when exactly we could expect liftoff, it sounds like you're saying it could happen sooner than we had initially maybe expected if this trend continues. I guess how soon? Give us a better, view of what that potential timeline could look like.
Well, I think that's where the risk lies, is that it's earlier than what the Fed has outlined. I think we've seen that with today's beat, but also the upward revision. So the jobs market is on a much stronger track. And when you look at the tightness there, I think the Fed's coming around to the idea that the labor market is very tight. And we're certainly seeing that with the wage numbers. We saw another very strong average hourly earnings number today. Even though leisure and hospitality, your lowest paying sector, saw some of the biggest job gains, but there you're seeing exceptionally strong wage growth within that sector. And I think that does point to this overall strong labor market that we continue to see.
Michael, some of what you're advising people is to lighten up on the most speculative, quote, liquidity-driven sectors, but you're also saying lighten up on bonds of all types. And yet, today, somebody, we talked about this the last hour, somebody or some large institutions are buying the 10-year. They're not listening to what you're saying. What mistake are they making?
Well, I think they're underestimating, two things that if we look back in history, we can kind of anticipate what happens when the Fed starts pulling back their liquidity provision. So first of all, what's the big thing they've been buying? They've been buying bonds, and that's been depressing real rates significantly. Right now, you've got a 1.5 thereabouts 10-year, and inflation's running north of 5. So bond investors are losing money relative to the cost of living. Obviously, inflation's not going to stay at that level, but you're going to have a significant increase in interest rates just to get to a zero rate relative to inflation. Secondly, the other sectors that we see as at risk is, if we think about the last time we saw this kind of environment where the economy was still going gangbusters, but the Fed was pulling liquidity out of the market, that was 2000, when they'd injected a lot of money because of Y2K problems that never materialized, and they spent 2000 pulling that money back out of the market. What happened? Well, not the entire market got taken out and shot, but the most speculative areas of the market. This time, we would say those speculative areas would be high-yield bonds. We would absolutely say things like, growth stocks that are sitting there at 200, 300 times earnings. Going back to the future, in 2000, the larger market did okay until pretty much so 9/11 and the tragedy and the recession from that. The things that got shot was Cisco, a great company, but at 160 times earnings, AOL, Pets.com, the very, very speculative things that needed those injections of liquidity to sustain those prices. You pull that liquidity, we think those sectors of the market deflate.
So another thing that we're keeping a close eye on today is the developments out of D.C. We were talking to our D.C. reporter last hour, Jessica Smith, and she was saying that we are preparing for votes on infrastructure and also the Build Back Better plans. But as an economist, I guess, how are you looking at, if these two bills are passed, how big of a boost are they going to be in this recovery?
So we are expecting the infrastructure deal to get passed, and we have that baked into our forecast. And we think at some point the reconciliation bill will get done, but as we've seen just week in, week out, there's still a lot of details to negotiate around, and that size of the package continues to get lowered in terms of what the total spending might be. But at the same time, the duration is potentially shifting. So it looks like you still would get some fiscal support here in 2022. I think from an inflationary perspective, while obviously given the price backdrop that we're seeing and how some of that has been tied to the massive fiscal support that we saw injected into the economy in the first quarter of this year, there are concerns about what this would do to the inflation environment going forward. But I think we have to look at the spend out rates of both these packages that are being discussed. And from there, it's a lot slower and more indirect than what we saw with the fiscal packages earlier this year. And so I don't think it has quite the same inflationary impulse that we've seen. And so overall, we're still expecting inflation to subside over the course of next year, even as it's likely you do get these deals passed at some point.
Michael, at the end of November, early December, we're going to have another battle royale in Congress over raising the debt ceiling. And while it hopefully won't drag on, what should investors be doing now in anticipation of that fight? I mean, the Democrats haven't been able to get their act together on things they support. So what's going to happen roughly 5 weeks from now?
Predicting exactly what's going to happen in Washington has been fraught with peril for the last couple of years. But my gut is telling me that the Republicans will not play ball on another extension of the debt ceiling. And that means that the Democrats in the Senate are going to have to do a reconciliation-based increase in the debt ceiling. They're not going to like it. They're particularly not going to like it in light of the election results that we just had. But that's going to give all the more motivation for the Republicans just to keep piling on with the bad news. Now, that will probably drag the process out. There could be some volatility based upon it. But at the end of the day, financial markets are starting to get tired of the drama around the debt ceiling. And I think most investors in the back of their mind are thinking this will be resolved, sanity will come to the fore. So while it may create a short-term spike in volatility, I don't think it's a long-term risk for the financial markets.
Michael Jones is Caravel Concepts CEO. It's good to have you here. Sarah House, Wells Fargo senior economist, thank you as well for joining us.